Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Monday, the 17th day of March, 2014, and this is the daily report for gold and silver. After 5 consecutive days of higher pricing, we do have profit taking occurring in the marketplace today in the precious metals markets in conjunction with the equities markets. After dramatic drops last week, the equities markets are now stronger. You've got the Dow Jones Industrial up about 181 points. You have silver off roughly 28 cents, 2107 on the low, 2158 on the high. Gold currently down about $14. That's off about 1% on the day. 1362.20 on the low and 1386.60 on the high. We'll talk about that high because that is significant, all on today's daily report. So traders, we're looking at a 480-minute chart, standard candlestick format. And obviously the question is, we're going to want to raise our stops to protect profits on our current trade. But I want to draw your attention to the different candlesticks that we've seen. You know, looking at it in hindsight, you can see that we, without a doubt, have a couple of structures that we have talked about before. The first thing that is quite apparent is if we look at the top of this market, and this is that 1388, you can see that that's capped off really by 2 dojis. Again, a doji is simply a candlestick in which the open and close are identical or very, very close together, very, very small bodied candle. They're also surrounded by large green candle to the left, and to the right you get a smaller red candle followed by this larger red candle. Again, we have that 3-river evening star variation. Now, we've seen this variation though, and we've actually seen this variation when it didn't really pan out to too much. But if you notice, here is a case where we have that 3-river evening star formation, but at the same time, what happened here was the market simply traded sideways for a while and then moved back up. So the question is this a short-term move, or are we looking at a potential top? There are a lot of reasons to actually consider the fact that we might have ended this wave here and are in store for a little downside, but we'll really have to see how it unfolds. Because as you know from a couple of our other studies, especially the Andrews pitchfork, this move puts it back within the confines of that cascading channel. And so that, in terms of a technical basis, has given me some concern. We've seen this market really take off. It exceeded our expectations in terms of where we were looking for this market to move on the upside on this particular wave. In terms of my intermediate and long-term forecast for the market, that really hasn't changed that much. I'm still looking for this market to move higher, but the question is, will it move higher now, or will we find ourselves deeply ingrained with some sort of a corrective wave here? So, traders, this is really the chart that I was talking about, and this is where I have some concern that we might in fact see this market back off a little bit. But it's really critical long-term that at some point we break through this channel line, because without breaking through it, what that tells us is that as much as we like to believe we're in a bull run, we're really in a counter trend. The market really has to break above that. Now, where are we at now? And really to see that, what we'll need to do, of course, is to really blow this up quite a bit. Let's do that, and then let's go ahead and kind of enlarge everything, and you can see exactly what I'm talking about. This, of course, is an enlarged move of that Andrews pitchfork. When we look at it in this way, you can see that it has exceeded, it has traded above, but red candle, the current print is the bottom of this red candle right in here. So we're back within that channel. And if in fact we see the market move back within the channel, where in fact could this take us? And that's going to be the discussion if we see this continuing to unfold this way. In other words, pressure on the precious metals markets throughout this week. If it recovers, it's another thing. But we have seen many occasions in this market where it's consolidated, such as right here, before popping higher. So I'm not convinced, and I don't believe we have all the technical evidence that we need just yet to determine that, but you can easily see when we look at it from this point of view what in fact is happening, and that is that for the first time we actually broke above this channel line and the outside prong, so to speak, of the Andrews pitchfork, but we have now moved back into this channel being defined by this particular prong here. This is the outside or zero prong, and that's what we will have to absolutely take a look at. Now, traders, we're looking at a 2-day chart. I'm going to go ahead and compress it in a second so you can see where all these numbers come from. But this is the chart that we've been using that has a lot of different fib retracement levels, and we've also looked at it from a level of harmonics. When we look at this and we look at this 2-day chart, let's go ahead and blow this up, you can really see this particular candlestick that's forming on a 2-day chart is absolutely a doji, but it's almost shooting star-like. And what a shooting star is simply put, let's go ahead and see if I can't draw a shooting star for us. Let me change my tool to a line tool and then maybe a black color. But what we're looking at with a shooting star, it's the opposite of the hammer. And simply put, a shooting star looks something like this, in which the body size is got to be at as little as or less than 1/3 of the tail. In other words, the tail needs to be 3 times the length of the body. That's what defines a shooting star. You can have a small tail on the bottom of a shooting star, but a shooting star by itself doesn't necessitate a sell signal. However, if you get the confirming candle, and the confirming candle, of course, would be the next day where you get a red candle. I'll draw this in blue, but you get a red candle with a lower low and a lower high. That would signal some sort of sell signal. Now, the other thing that we want to notice is it's coming in right at this level, and this level here, of course, it's trading at 66, but let's go ahead and compress the chart right now so you can see where these levels come from. And it takes quite a bit to compress this all the way down. When we do that, you can see that it's stalled right here. This is that 1373, and we talked about that as being a minor point, and then 1413. These are our major areas right here and right here. Now, the next level, really strong level, doesn't come in till about 1300, and it's quite a ways away from there. So we want to look at some of our shorter term studies to determine where, in fact, the market could go to. But considering that we've seen a $200 plus move in the market, any kind of real retracement could be anywhere between 23, 38, 50, or 61% of that particular move. So traders, all I've done is I've pulled up our 2-day chart. This 2-day chart we have been looking at in terms of the long-standing resistance line, and we have our intermediate Elliott wave count. We've not really added this as a wave 1 or an A yet. I'm kind of leaning towards 1 because I believe that we have the opportunity to not be witnessing a counter trend and to actually be witnessing a bullish reversal in terms of the marketplace itself. But we're right on the cusp of that, and that's why it's so difficult, especially with the Andrews pitchfork. But assuming that this market has played out this first part of this wave right in here, what we're looking at are different levels. So a move back down that would be a 23% retracement would take us to 1341. A 38% retracement would take us to 1311. A 50% retracement of this move would take us to 1287. So those are the different points that we could see this market move down to quite easily and still be tracking a bullish move, because we would see it simply look at a wave count like this, retracement, and then a move back up. I believe that following this corrective action, however this corrective action really unfolds, if in fact we see follow through and the market starting to move down, I would look for it to fall into one of these 3 categories, 50, 38, or 23. But the important thing is following that, we should come really back up on that next impulse wave to actually take out this most recent high at 1435. Now, within this, let's assume that this is a wave 1 or a wave A. This, I believe, is the sub count behind that. So all of this 3 or 5 count that we will see in the marketplace is all going to be part and parcel of a single wave. So we're looking at our sub count right now that would either be defined within that A wave if it is an A wave, or wave 1 if we've truly entered in impulse phase. Now, when we look at this very, very long-term chart, and this right here is a 9-day chart, so it's even more compressed than a weekly chart, we're still solid green. Obviously, a day like today, even with a $14 or $15 lower pricing, is not really going to affect that. But you can see that we've gone back into and below this particular top or resistance, and you can see how the resistance has really hit. This is 1377. 61% retracement, or excuse me, a 61% retracement at 1377, and that's of course of this shorter move up here. So what are we looking to do? Well, my sense is we absolutely want to raise our stops. There's no doubt about that, and to do that we want to maybe pull up a chart that's not a 9-day chart, but we want to actually look at our daily chart, because our daily chart is going to tell us where to put that stop. So traders, we're looking at a daily chart, and when we look at the daily chart in terms of the range today, I typically like to put a stop, a minimum of below the low of 3 days. So we've got 1, 2, 3. However, the low today actually went below that of 3 days, and then this is that dramatic rise. Now our stop is currently sitting at just below 1340. My recommendation is the low today is 61, so we'll probably want to move our stop to 57, 58, because we want to put it below this low. In other words, what we're saying is, if it makes a new low, let's get out, we'll take profits. Even if it makes that low and then moves back up, as we did before, we can go ahead and re-enter the market. I'm never afraid of doing that. But traders, my suggestion, and I'll put out a special trade alert just prior to publishing this report, is that we want to take our stop to around 1358 on a protective stop. Now traders, we're looking at our silver chart, and as you know, I'm nowhere near as bullish on silver as I have been on gold. And one of the primary reasons and rationalizations is that when we look at this long-standing resistance line, you can see the market's made it too, but never really been able to effectively break above it. Not like we saw that genuine breakout in gold. Now, why are we getting this separation between gold and silver when they tend to run in tandem? And my belief is obviously that the equities markets have contributed a lot to the price of silver, because it is an industrial metal. So as we saw the equities under pressure, it put pressure on silver. There's no doubt about it. So in silver, in the same way, you can see over the last 3 days, 2108, that's the low. And our stop is sitting around just below 2090. So we're right at the same place. Silver has really not moved up all that much. In fact, we're right at that point where we entered the trade. My suggestion on this is to actually take our stop and actually move it to 2090, but not below it, so that we are giving it that wiggle room, but actually move it to 2090 on a protective stop. This has been Gary Wagner, wishing you as always good trading. Talk to you tomorrow for another daily update and review. Bye-bye.